Okay, good morning everyone. We are about to start our session on new trends in financial regulation. I'm pleased to announce my colleagues here. We have a slight change in plans this morning. Mr. Professor Jean-Charles Rocher is going to arrive a little after our meeting today. So I'm glad to have here Michael Spence to join us for this debate. This is a very important issue today, no doubt about that. We are very pleased to have this discussion here in Brazil. I'm as head of regulation at the central bank. I think it's very important to have a greater involvement of the economic profession thinking about the issues of financial sector regulation. In particular, in these very challenging times that we have to learn as fast as possible many of the lessons of this financial turmoil that we are experiencing for a while. The presentations here, this is more like a debate. We'll have first Rafael Repullo, which is studying one of the key issues today in terms of perhaps some of the general lessons that we can take from what's happening today in financial markets, which is the whether financial regulation and supervision has a procyclical component and how to deal with that. So he has a presentation that he's going to do in just a minute. My other colleagues here, Edward Lazear, which is the chairman of the Council of Economic Advisors of the White House, will bring us some perspective on this financial crisis, talking about causes and remedies for what is happening today in global financial markets. And I'm pleased to have also Michael Spence, that was just in this room a while ago, speaking about many issues, including financial crisis, and will take upon this debate. The work plan here is to have 25 minutes sort of presentation and leave 15 to 20 minutes for the floor for our open debate. And without further delay, I would like to give the floor to Mr. Repullo for his presentation.
Okay, is this working? Yes. Well, thanks very much. It's a pleasure to be here. I guess that the session is going to be from the specific to the general, and my role is to speak about the specific. In particular, I will be presenting, without going into the technicalities, a paper that I've been working on for some time with Javier Suarez, which is a colleague of mine at CEMFI in Madrid. Now, the paper is on a very topical issue, so I will start with a few quotations. The first quotation is from this report of the Financial Stability Forum, which was published in April. It says, supervisors will assess the cyclicality of the Basel II framework and take additional measures as appropriate. Chairman Bernanke, in his Jackson Hole speech, had this paragraph. We should critically examine capital regulations, provisioning policies, and other rules applied to financial institutions to determine whether collectively they increase the procyclicality of credit extension. The European Union, the Council of Finance and Economic Ministers, last month had this statement. Implementing the new Basel II framework, banking supervisors will monitor the potential procyclical effects of the new regulation and assess whether the remedial measures are needed. And finally, last week's declaration of the Summit on Financial Markets and the World Economy said the IMF, this proposed expanded Financial Stability Forum, and other regulators and bodies should develop recommendations to mitigate procyclicality, including the review of how valuation and leverage bank capital, I stress bank capital because that's what this paper is about, executive compensation and provisioning practices may exacerbate cyclical trends. So, I mean, this is basically the background in which this paper fits, and so the purpose is to assess the extent to which bank capital regulation can lead to amplification of business cycle fluctuations. And in particular, what the paper tries to assess is whether in moving from Basel I to the new framework Basel II, things are going to get worse, and if so, what would be the appropriate policy response. Just to be sure that everyone is on board, what do we mean by bank capital? Well, just a simplified balance sheet here. Suppose that on the asset side we just have loans, and the liabilities you have deposits and capital. So capital is sort of a liability, is the funds provided by the shareholders, and the sources of this capital are equity issues, retained earnings. So that's the kind of framework, that simplified framework that I'm going to be working on. And what is a capital requirement? Well, it's a requirement that capital should be capital should be at least a certain fraction of the amount of lending risky assets that the bank has. And in Basel I, this magic number was 8%. I'm going to call it gamma. In Basel II, it's determined according to a value of risk calculation that I don't have time to report. But anyway, I mean, basically, a capital requirement is something that works like that. Capital should be greater than or equal to a fraction gamma of the amount of risky assets lending. And therefore, from here, you can immediately get some sort of limit on the lending, an upper bound on the lending capacity of banks, which is given in the Basel II framework by 1 divided by 0.08. So 12.5 times the volume of capital is the maximum amount of lending that a bank can give. And from here, it follows that what one may call the bank capital amplification channel, which is, suppose that you go into a downturn, then in principle, you're going to have much lower bank capital due to higher default rates or losses incurred in other business, in other parts of the bank business. And then at the same time, under the Basel II regime, you're going to have possibly much higher capital requirements. So that's going to, if you go back to the previous slide, you're going to have a higher gamma and a lower k. So therefore, that's going to make the constraint much tighter. However, two conditions, and this is basically the starting point of this paper, two conditions are necessary for this effect to take place. First of all, banks should find it difficult to issue equity in downturns. I mean, the point is that you have this constraint that has become much tighter, but if you can go to the capital market and raise equity capital to rebuild your capital, then in principle, there shouldn't be a problem with your lending. And secondly, even if this is not the case, if firms can go from one bank which is constrained to another bank which is not constrained, or alternatively, if firms could go from banks to non-banks to go and issue securities in the commercial paper or whatever in the market, then of course there wouldn't be any problem because these firms will find their way to get the funding that they need. So we need these two conditions in order to have the bank capital amplification channel. But however, these two conditions are not sufficient because with high capital buffers, if the banks anticipate that by entering into a recession, they may face this constraint. They may take precautions. They may build up capital buffers so that the constraint would not be binding ex post. So in particular, there is a quotation here that from a recent paper by Jean-Charles Rocher, and I wanted to make some discussion with him in this floor. Unfortunately, he's not here. He stated that additional capital buffers should allow banks to maintain a reasonable volume of lending activities even during recession. So he was pointing out to the fact that these two conditions are not necessary. If banks anticipate that this may happen, they are going to have an incentive to build capital buffers, and therefore they will be able, according to Rocher, to maintain a reasonable volume of lending even during recession. So that's the kind of thing that this paper tries to assess. And so how do we do it? So the key issue is will endogenous capital buffers neutralize the procyclicality of bank capital regulation in a model where you have these two characteristics in which banks find it difficult to issue equity in downturns, and secondly, firms find it difficult to switch financing source, especially in downturns. So that's, and the answer, just to preview the results, is that under a particular parameterization, which we think that is reasonably realistic, says that with Basel I, basically yes, with Basel II, basically no. So we do have a problem in going from risk-insensitive to risk-sensitive capital regulation of the Basel II type. Okay, so let me just outline. I mean, this is a quick preview of the sections of the paper, and I'm going to basically skip most of the analytical part because for the sake of saving time. So I will just give you a brief outline of the model setup, some of the analytical results that one can get from this setup, and then most of the interesting part of the paper, I think, is the numerical analysis, and so I will sort of go over some of the tables that show what are the results that one obtains here, then what is the appropriate policy response, the policy analysis, and finally we'll just conclude with future research plans, which I think are pretty interesting. Anyway, so the model setup, what we have in this, it's extremely simple. I mean, the model gets very complicated, very rapidly, and then that's the reason why we end up doing numerical simulations. So it's an infinite horizon discrete time. It's a Markov switching model. I mean, the economy can be in two states. It can be in good times, in bad times, recession, expansion, and there are some transition probabilities between these two states. At each day t, there is a continuum of entrepreneurs that is going to enter the market, and these people are going to live for 2 dates, 2 periods. So in a way, we have an OLG structure in this setup. One of the features of this model is going to be this relationship banking. So entrepreneurs, when they get started, they become dependent on their initial lenders. So they lock in with a particular bank, and they cannot switch financing source in the second period. That relates, of course, to one of the necessary conditions that I referred to before. And so in this model, what we're going to have is that the banks are going to have a lot of power, market power exposed, because these people cannot go elsewhere, so they're going to get a lot of rents exposed, but ex ante is going to be perfect competition, and that's going to be pinning down the interest rates in the initial lending period. The second assumption is that we're making is that banks with ongoing relationships, i.e. the banks that started a lending relationship and then are continuing with a particular cohort of entrepreneurs, cannot go to the market in the second period and raise equity capital. So that's the other necessary condition that we're imposing as an assumption. So what happens here is that banks will only be able to raise capital every other date. The idea is that once you clear up your stock of entrepreneurs, then you can start new lending relationships, and at that point you can raise capital. So that's some sort of very simple structure. And finally, what we assume is that loan losses in this model follow the single risk factor model that underlies the capital requirements of Basel II. So in a way, I mean, we're assuming that we have the same stochastic structure that the one that is used in Basel II to compute the value of risk capital requirements in that framework. So notation, a little bit of here. The state of the economy, S at day t, S sub t, can take two values, can be either H or L, and it follows a Markov chain with transition probabilities QH and QL, and I will later tell you what are these numbers. The state is going to determine the probability of default of the loans that are granted at those two possible states, and so it can be PH or PL depending on the state of the economy, and of course H is high, L is low, so PH is the probability of default in a high default state, and PL is the probability of default in a low default state. So state H, and maybe this is a little bit of a confusing notation, is high business failure or recession. State H state H is a recession. State L, low business failure, is an expansion. Now, so that's the setup. We are going to assume that deposits are fully insured. That's not really a problem in this model, because the probabilities of bank failure are going to be tiny here, because I mean, I'm basically assuming the 99.9 confidence level of Basel II. So banks are going to have sufficient capital so that even if you had to compute fair deposit insurance premium, these are going to be tiny. So this is not going to make any difference. I'm going to assume that capital is costly, and the cost of capital delta is positive. Remember that 0 is the normalized cost of deposit funding. Initial loan rates are denoted RL or RH, depending on the state in which these are granted. Initial capital of the banks that can issue equity is KH or KL, depending on the state of the economy. And the capital requirements are in Basel I just the 8% rule, the gamma H equals gamma H. And in Basel II, the gamma L is lower than gamma H. And this corresponds to the outcome of sort of this, the well-known Basel II formula. So capital buffers are going to be denoted by delta. Delta L is the difference between the capital that the bank decides to hold in state L minus the capital requirement gamma L. And delta H is the same thing for the high business failure state. So deltas are the buffers, and this is, of course, a crucial ingredient following Roche's idea. So banks, in principle, what Roche is suggesting is that they're going to have more buffers under Basel II because they anticipate that things can turn bad, and therefore they will be required to provide extra capital to support their lending. Now notice that this incentive to hold capital is particularly strong in this model because these banks are going to have a lot of rents exposed. I mean, remember that exposed, the borrowers are captive. They cannot go elsewhere. And so the banks are going to extract a lot of surplus exposed. So they do have an incentive to be able to be active and lend to all these people. So what is equilibrium here? It's just a pair of capital, initial capital, and interest rates that satisfies banks optimization. The banks are going to choose the capital that maximizes, this is the short for the expected profits, given the market interest rate. This is a perfect competition type of model. And then we are going to pin down the equilibrium interest rate by this zero net present value condition that says that, in this equilibrium, expected profits are equal to zero. So therefore, the banks just cover the cost of capital and the cost of that's basically the only input that they have. Okay, what are the analytical results here? Well, we get a few analytical results, although some of the bank's objective function is neither concave nor convex. So therefore, I mean, there's a limited amount of things that you can do in that. So you may have corner or interior solutions. Corner solutions are solutions in which the bank's capital is at the minimum, at the 8% under Basel I. You can have interior solutions, and you do have a lot of interior solutions. So in general, these banks are going to hold capital buffers. Now, there are some comparative statistics for the interior solutions. So, for example, higher capital requirements is going to lead to higher equilibrium loan rates, and that's because capital is costly, so part of the cost is going to be transferred to the borrowers in the form of higher interest rates. But higher capital requirements have an ambiguous effect on bank capital. So why is that? Well, I mean, there are two reasons. On the one hand, this is for interior solutions. On the one hand, you have a high probability of ending up with insufficient capital. And remember that lending exposed is very profitable. So you do want to have the capital in order to be able to support this lending. But on the other hand, this lending is less profitable because you have to bear the cost of a higher capital. So these two forces pointing in different directions imply that, basically, there isn't very much that one can do analytically, and so we resort to numerical solutions. So what are the parameters used in the numerical solutions? Well, on the transition probabilities for annual frequency, I'm going to assume these values for the QH and the QL. I mean, it's easier to see what they mean in terms of expected duration of high and low default state. The high default state is 2.8 years. I mean, if you think in terms of business cycle frequencies, these may seem to be too large, I mean, too long recession, but you should think about this in terms of credit cycles. And in credit cycles, I think that such duration is not that long. And on the expected duration of the good state, the assumption that is implicit in this 0.8 is 5 years. It's 1 divided by 1 minus q. So it's 1 divided by 0.2, which is 5 years. Okay, the other assumptions, we're going to assume that the probabilities of default are constructed in the two states of the economy, PL and PH, are 1.1% in the good state, 3.3% in the bad state. Now, in Basel II, this imply the capital charges of 6.6% and 10.5%. Remember that these charges are sensitive to the risk, and the risk is given by these probabilities of default. Now, where do we get these numbers? Well, I mean, at least the initial idea of the paper was to compare Basel I with Basel II. We wanted to pick some parameters under which, across the history of this economy, the capital requirement under Basel II was 8%. So basically, the average of 6.6 and 10.5 given the probabilities, the average probabilities of visiting each state, is going to be 8%. So basically, we are comparing two structures which have the same average level of the capital requirement. In one case, the capital requirement stays flat. In the other case, varies with the state of the economy. So that's the way in which these numbers are. And then other parameters, loss given default, I assume what is in the Basel II, 45%, the foundation approach of the Basel II. And the cost of bank capital, I'm taking a number equal to 4%, and we do some sensitivity analysis with this number. Okay, so this is probably the most interesting table. I mean, the first most interesting table, which tells you what happens with the equilibrium loan rates and capital buffers in this model once you solve numerically the equilibrium. Now notice that, I mean, this row tells you what happens under Basel I, and this row tells you what happens under Basel II. Now notice that there is very little action on interest rates. So interest rates don't change very much. And the reason is that, well, basically what is behind these loan rates is, well, expected profitability of future lending as well as the cost of bank capital. Now, under Basel II, banks are going to hold more capital, especially in that state, the state RH, the high default state, and that translates into a higher interest rate. But this is minimal. Now, on the capital, you have here the levels of the capital that the banks are holding. Notice that the capital is around 11% under Basel I, so that means that the buffers are around 3%, which is, well, I mean, not, I mean, it doesn't look as an outrageous figure. I mean, it looks pretty reasonable, I think, given the evidence that we have. Anyway, the interesting thing is that when you look at the behavior of the buffers over the business cycle, in Basel I, they are slightly counter-cyclical. So notice that in good times, delta L is 3%, in bad times, it's 3.2%. Now, this kind of behavior has been sort of reported in a series of empirical studies that use data during the Basel I period, which is the only one that we have. So, I mean, it seems to accord with the kind of empirical evidence that is available for several countries. Now, notice what happens in Basel II. In the good state, in the expansions, the banks are holding 5.1% buffer. So they have a huge, much bigger than what they have under Basel I. And notice that the buffer is now strongly pro-cyclical. So now in good times, the banks are going to be holding more capital in excess of the one required by regulation. The one that is required by regulation is only 6.6%. They are holding almost 100% more just to take into account that the economy may turn into a recession. So, I mean, this seems that, is this sufficient or not? So that's a question that we try to answer, and here's the answer. So credit rationing is we define as the expected percentage of second period projects that are not funded because of banks' insufficient capital. And so what we look is what happens in a state tomorrow, S prime, conditional on a transition from state S. Focus on this column. So we are in an expansion and we go into a recession, right? So under Basel I, only 1.4% of these projects would not be funded because of the bank's capital requirement. Under Basel II, a little bit over 10% are not funded. So basically, you have a very significant increase in credit rationing as a result of these, despite of the fact that these banks are taking precaution. They are holding more than 5% in capital buffers, right? So what's the story here? How can you sort of understand this? Well, remember that these shareholders, bank shareholders, are rational individuals. They decide on the capital, taking into account the benefits and the costs of holding capital. What is the benefit of holding capital? Well, the benefit is that you will be able to support your lending exposed. What is the cost of holding capital? Well, capital is costly. So therefore, in equilibrium, you are going to trade off these costs and benefits. And it's not reasonable to anticipate that you are always going to be able to support your lending, because if there is no rationing there, then perhaps these shareholders should think about reducing the amount of capital buffers in order to reduce the cost of this input. On the other hand, if you have too much rationing, then the bankers would have an incentive to raise their capital buffer. So there is an equilibrium. There's going to be a point in which there is some more rationing in a state, and of course, if you continue if you start on L and continue in L, there is almost no rationing. So basically, the bankers are holding a lot of capital in anticipation that this may happen. But of course, when it does happen, then they're going to have a problem in general. And this is, of course, an average because it depends on the realization of the defaults. So that's what happens here. And that's what makes Basel II very different from Basel I in terms of rationing. Okay, what happens with bank solvency? I can be quick here. The probabilities of bank failure in either Basel I or Basel II are going to be pretty small. I mean, basically, Basel II is going to make banks safer. Notice that these numbers, the risk of bank failure is much lower than the 0.1% targeted by Basel II. I mean, remember that the confidence level that is used in Basel II is 99.9. So these are numbers which are way below the 0.1%. And this is, of course, due to the capital buffers. I mean, the 99.9 is for the capital requirement. If you have more capital, then you're going to be safer. And also, the computation of Basel II doesn't take into account that banks are going to be making some money. There's going to be some net interest income there. Okay, so a little bit on the looking at the effect of parameter changes to see how the model sort of reacts in the sort of anticipated manner to changes in these parameters. Suppose sorry, no, let me skip that. Higher cost of bank capital. Suppose that the cost of bank capital, instead of being 4%, goes to 5%, right? Now, well, I mean, there's going to be some effects on the interest rates and capital buffers, but look at what happens with the rationing. It's more than doubles the rationing. I mean, so if bank capital is more costly, then the bankers, the shareholders, are going to save on capital, and that's going to increase the extent of rationing if you ever go from a low default to a high default state. And so that's a very significant. So you have higher rates, lower buffers. The bankers will save on capital because it's more costly, and then the rationing is going to increase. What happens with, suppose that the expansions are longer in duration. Suppose that we were in a few years ago when you thought that recessions were part of history, and so the duration of the expansions were going to be longer. I mean, even going from 5 to 6 years in terms of the expected duration, changing the parameter Q of the transition probability is going to imply that rationing goes from 10.7 to 18%. So notice that, I mean, what happens is that, again, is this trade-off. You hold capital in order to anticipate, to support your lending if the economy goes into a recession. If it is less likely than the economy is going to go into a recession, you have less incentive to hold capital. So therefore, you have less capital buffers. You go from 5.1 to 4.4. And therefore, if we ever go into a recession, then you are going to have more rationing of your lending. Finally, I mean, in the paper there are 3 scenarios in terms of cyclical variation of probabilities of default. And if we go from the medium volatility scenario to the high volatility scenario, which, by the way, this scenario is a way to think about situations in which the loss given default varies with the cycle. So, for example, it is reasonable to assume that when the economy goes into a downturn, bank lending is more risky, not just in the sense of higher probabilities of default, but also higher losses given default. Now, if you think that this is, so this scenario is perhaps even more plausible than the middle one. So again, notice that with a higher volatility in the probabilities of default, that means that when the economy goes into a recession, the capital requirement is much higher under Basel II, and therefore the restriction on your lending is higher. So you have much higher rationing in that situation. So let me just a brief summary of the effect of parameter changes. The qualitative results that we get in this analysis are robust to changes in these parameters, but the direction of the change sort of is what you would get from your intuition. Rationing when entering a recession is going to be greater in economies with higher cost of bank capital, lower probability of going into a recession, longer durations of the expansions, and also higher cyclical variation in the probabilities of default. So policy, what can we do in the context of this paper, which I of course, want to stress that this is a very stylized framework, and it's not, you may think that it's pretty far away from the real world, but at least that's what we can provide. Now, so the objective would be to reduce the incidence of credit rationing, especially when the economy goes into a recession, without major costs in terms of bank solvency. So we wanted to play a game in which we keep the average level of bank solvency over the business cycle, as opposed to getting a minimum level of solvency in different states of nature, and reduce the incidence of credit rationing. So the idea, we have two policy experiments. Let me just focus on policy one, which would be reduce the confidence level to 99.8, from 99.9 to 99.8, when the economy is in a recession. So you're going to relax the capital requirements in a recession, lower capital requirements in a recession. And then, but since we want to keep the sort of across the cycle level at the 99.9, what we do is increase the confidence level in the other state to keep the average at 99.9. So that's a little bit, I mean, short of a welfare analysis, which is what I suppose one should do, this is the kind of policy experiment. The other policy too that I want comment is that you reduce only in the transition. So only when the economy goes into a recession, then you lower to 99.8, and then you increase the confidence level in state L to keep the average at 99.9. So anyway. So this is what you get in terms of the rationing results. Again, is the rationing in state S prime conditional on this transition. Now look at this row, which is the one in which you had the high rationing under Basel II. Now it goes, when you go from Basel II to this policy one, this counter-cyclical adjustment in capital requirements, then you really reduce the extent of rationing there. And the cost is very small, I mean, in terms of increasing rationing in the good state of nature, and also you also improve things on when you stay in a recession as opposed to in Basel I. So the if you look at so both policies achieve significant reductions in credit rationing, and they have small effects on bank solvency. At any rate, bank solvency is going to be lower in bad states of nature because you are relaxing the capital requirements. But at any rate, the probability of bank failure stay below 0.08%, so below the 0.1% that you had a target in Basel II. Okay, so let me just conclude. How am I doing with the time, Mr. Chairman? Hey, how much time do I have?
Just to conclude.
Okay, so let me skip then this one. The purpose of the paper is to evaluate procyclicality of bank capital requirements, and remember that this is a very stylized model. We only focus on the supply side of the credit market. So demand side or feedback effects are completely ignored. So I mean, so this is something to be bear in mind, because it may be the case that if you go into a recession, then the demand for loans go down because of lower activity, and therefore at the end of the day you are going to have much lower rationing because you are only looking at the supply side. And so I have a brief summary of what this paper. So the methodological, the paper provides a dynamic model of the credit market with these two ingredients: relationship lending and frictions in banks' access to capital markets, to equity financing, and provides a theory for endogenous loan rates and capital buffers. And the numerical results on Basel II show that if you change from the regulation to Basel II, they're going to have pro-cyclical capital buffers. So the banks are going to be taking precautions in the new environment. So they're going to be building higher capital buffers. But nevertheless, there's going to be a risk of a credit crunch when the economy goes into a recession. And a possible policy response is to have some cyclical adjustment in capital requirements. One final slide on future research. What am I doing now? Well, basically, the model is very well, but to go from this theory, how are you going to be making these adjustments, and what is the information? So the research that I'm currently doing is basically try to pin down some alternative for doing this adjustment, and basically as everybody knows, the devil is in the detail. How are we going to do that? So there are basically two alternatives. You can smooth the inputs of the Basel II formula by some sort of through-the-cycle ratings, and this has been advocated by many people, including some Basel committee officials. Or you can smooth the output with using point-in-time ratings to determine the probabilities of default, and then smoothing the output of the Basel II formula. And you can either use aggregate business or credit cycle information, or you can use individual bank information. And what we're going to be doing in the coming weeks or maybe months is to compare this alternative using this very large data set that the Spanish Central Bank has collected, and we have almost 20 years of data. And basically, the data set is all the loans granted by all Spanish banks during this 20-year period. So it's basically the entire population of loans. So hopefully we can get some. I mean, basically, the idea is to apply to this situation, assuming that going to Basel II doesn't change the behavior of the banks in terms of the lending, and see how the different smoothing procedures work with this kind of sample that we have. Anyway, so thanks very much.
Thank you very much, Rafael. It was a very interesting piece. I think it's very specific lessons and some interesting policy recommendation. Without further delay, I would like to give the floor to Edwards for his presentation. He does have a presentation there. Yes.
Okay. I'll wait. Give it a minute here. There we go. Good. Okay. Thanks very much. Good. Thank you. All right. Well, what I thought I would do today is to thanks. Perfect. Yeah. Good. What I thought I would do today is to talk about the recent financial crisis. Given that I am in the United States government right now, I'm going to focus primarily on the U.S. And some of the things that have happened to us and what we're trying to do about it. I apologize for not having a more international focus here. I'll try to at least discuss some of the international data when I come to it. But since many of you believe, and not without reason, that much of this has to do with what's happening in the United States, I think hopefully it will be relevant to you. All right, well, how did we get here? I think this is something that we will be studying for many, many years to come. But I think the current conventional wisdom is that we got here in large part as a result of a massive flow of funds that became available to the industrialized countries over the past decade or so. This is often characterized in terms of the global savings glut. The global savings glut, it was primarily a result of developing countries, most notably China, saving at very high rates relative to their GDP. So depending on when you look, a couple of years back, if you looked at the numbers, China was saving about 52% of its GDP and was investing somewhere in the neighborhood of 45% in China. That's a lot, obviously, but it also meant that there was a flow in excess of 7% that was going to the rest of the world. And in some sense, that's a puzzle, of course, because if you think about this in a life cycle context and you think, when do you save and when do you dissave, you tend to, you don't save when you're an undergraduate. That's when you tend to borrow. And you save when you're making money, and then you dissave as you retire. That would be sort of the standard thing. So we ought to be thinking of China as an undergraduate in some sense, and yet they're saving at these enormous rates. And that's probably unprecedented in terms of, at least in terms of magnitude in the history of the world. So if we look at the, let's see here. There we go. If we look at the following chart by the Federal Reserve, you can see the numbers. Look back in 1966, and what you see is that in '66, the developing countries were net borrowers, and then by 2007, they were net lenders. This is the current account. So they were net lenders, and this is a huge shift. And then Conversely, if you look at the industrialized countries, you see they were net suppliers of capital in '96, and then, of course, by 2007, as we know, they were net users of capital. So that's an enormous shift over that period of time. Well, what's that done? Well, that resulted in differences in the credit spreads, which we see here. So if you look at the trends over time and look at the difference between the rates on junk and the rates on AAA assets, you see that as an empirical matter, this is usually put in terms of reaching for yield. That's the kind of layman's vernacular for it. I think basically what that means is that the elasticities were such that as the supply of capital went up, the demand for capital in high-risk assets grew by more than it did for the low-risk assets. That's not a necessary consequence, but empirically that's what we see. And so you see, if you look between, say, 2002, 2003, or even 2001, and compare that to 2007, you see an enormous change in the credit spreads, so that the ability to finance risky projects became much greater as you moved into the 2005-2007 period. All right, well, so what happened? Well, that showed up probably the most in terms of housing. And this boom took place in the United States because what it did was mortgages became much more available, the cost of borrowing went way down, and we saw that show up in housing starts. And so if you look at the trend in housing starts, you'll see that by 2006 or so, we had peaked out at about 2.25 million housing starts per year, and that's well up from the average of about 1.5 to 1.6 million per year. If you look at the demographic models, the typical demographic models, they usually imply that under normal depreciation rates of housing that you should get something like 1.6 to 1.7 million a year housing starts to have a long-run equilibrium, and we're looking at numbers well above that. So what does that mean? Well, of course, that means that housing prices are going to fall. But one of the things that's interesting is that the financial side of this story, there we go, took the form of loose borrowing standards. And of course, we've all heard of subprime. And subprime loans here, as you can see, it may be a bit surprising, but this trend actually started in 1993, and actually the changes, the relative changes, were more pronounced in the 90s than they were in the 2000s, although of course the magnitudes are greater in the 2000s. But with the exception of that dip during the recession of 01, you basically have almost a straight line trend up. So this subprime phenomenon, we just didn't notice it, but it's been going on for a long time. And that was consistent, I think, with policies, to be honest, with policies that were pushing home ownership. I think both the Clinton administration and the Bush administration felt that it was a good idea to have home ownership, and so that was a policy that we encouraged, and to some extent with the fallout of getting more and more people into high-risk, high-default loans. All right, so what happened? Well, what happened was 2.25 million housing starts, 1.6 million housing starts being the long-run equilibrium. Eventually, you start getting housing supply exceeding housing demand, and what that does in markets is it puts downward pressure on prices, which we saw occurring starting about 2006 in the Case-Shiller index. There are a couple of indexes of housing prices, or if you look at the FHFA index, used to be called the AFEO index, starts a little bit later, but there's no doubt that housing prices have been declining, so that means that as a result, that caused a couple of problems. The main problem that it caused was that people who were expecting to refinance their houses found it much more difficult to do so. And the reason for that, of course, was that the equity value that they thought they would have in their house simply wasn't there. That was particularly pronounced in the areas of the country that had the most rapid run-up. So, for example, Mike and I are both Californians, and one of the most troubled areas in the country was actually in the Central Valley of California. Central Valley of California had tremendous run-up in housing prices in the period from 2004, 2005, 2006. You know, these places appreciated like 100% in that 3-year period. And then the thing just turned around, and then in a year they lost 30%. So, you know, if you bought back in 2004, you were probably okay. But if you bought in 2005, 2006, and then had to refinance your house, you just didn't have the equity value in it. And so refinancing became very difficult. Default rates went up. As a result of default rates going up, we saw banks having problems with their capital requirements. All of those things in turn caused problems for the financial sector, and that's basically what we see right now. So how did that show up in the financial sector? Well, again, because of these high default rates, and by the way, it wasn't confined only to the housing sector. We saw it in other things as well. Student loans, places where you wouldn't have expected it to show up. Student loans is actually a very good example. Student loans are government guaranteed, 97% government guaranteed. And yet these markets were failing as early as March. You had these things called auction rate securities, which was a kind of a clever design, a clever way to bring about a new innovation in financing. And it took a while for us to figure out that that didn't work. It wasn't a very robust kind of institution. And so these markets just failed. And people were simply unable to refinance or resecuritize these student loans, even though they were 97% guaranteed. So again, a total surprise. No one would have expected that. I don't think anyone would have forecasted that if we were kind of saying, what kind of regulation should we have to anticipate that? I can't even think of one ex post, certainly not ex ante. So, so those are the kinds of problems that we encountered. What happened? Lots of bad stuff, as is illustrated by this table here. A lot of write-downs, about $700 billion of write-downs since the start of 2007. Major banks were among those. Some of them are still around, a couple of them not. And a large number of important institutions failed or became distressed. Oh, thank you. Or became distressed, and there's the list. Those are all familiar names. So that's what we saw happening there. What else? Well, okay, so that's the situation that we currently find ourselves in. It's kind of a mess. And the question is now, what do we do about it? How do we get out of it? Well, there have been primarily 3 areas of response that we've tried. One is that the Federal Reserve got in very early and tried to improve liquidity. Many of these problems, by the way, seem to be liquidity problems, but the distinction that economists and financial economists in particular make between liquidity problems and solvency problems became very blurred during this period. And the reason was that institutions that seemed inherently solvent, like Bear Stearns, for example, what happened was there would be a liquidity run. So all of a sudden everybody would get nervous, and many of these firms borrowed short-term and loaned long-term. That was the big problem in the financial sector. So they were highly leveraged. They would lend long-term to get the high rate of interest, and they would borrow short-term. What that meant was that people would come in and ask for their money. The short-term debt would come in and ask for their money, like bank deposits. They'd give me my money. And then they couldn't sell these assets, these long-term assets. So what they had to do was they had to dump these assets, and they would dump them at fire sale prices. As a result, they'd have to sell these things at very low values, and so even though they had been carrying them on their books at these high values, which made them look like they were solvent, once there was this liquidity run, coupled with the fact that the market was distressed, that turned into a solvency problem, and that's how this thing actually ended up causing so much damage. So part of the problem was for the Fed to get in and deal with the liquidity side of it, and they took a variety of steps early on. And this is a list of some of the most important ones, starting with the term auction facility, which made funds available on a longer-term basis to the depository borrowers. And this is essentially something to maintain liquidity. Now, in fact, the Fed had gotten in early last August, a year and a half ago almost, August. They started aggressively trying to lower interest rates, doing a variety of things like that to improve liquidity. But this is one of the things they did. Most recently, the commercial paper market, which is a very important source of funding for business growth, and business growth, of course, is essential in terms of job growth. That market's not been working, so people can't float their commercial paper. Even very sound institutions cannot float their commercial paper. So the Fed launched this commercial paper funding facility where the Fed, through a conduit, offered to buy up, special purpose vehicle offered to buy up this commercial paper. It's working very effectively. Unfortunately, they are still the buyer of first, middle, and last resort. It has not yet generated what we hope would happen, which is that you'd start to get a market in these things outside. There's a new facility that may end up helping on that score, but again, things are still very, very tough. The second thing that was going on was something on the borrower side, and that was these foreclosure prevention programs. They started very early as well. So the first foreclosure prevention program was actually initiated last August, again, August 2007, and that was to help refinance borrowers with good credit histories into FHA-insured mortgages. There was another thing called the Hope Now Alliance, which was essentially a group of private financial institutions, and there was an attempt to get them to do some additional write-downs, restructures, modifications of their loans. That helped some. They've made good progress. Question is how much incremental progress. We think they took a new step recently, about a week ago, by adopting a new protocol to try to bring people into a more affordable situation, and hopefully that will have some effect. And then there's another program called Hope for Homeowners, which is another write-down program where FHA will give some insurance to institutions if they're willing to write the loan down to 90% of its initial value. So again, those are programs that are involved. Now, this is a classic situation of adverse selection here. This is always a problem because you put in a program, and what you're basically doing is you're giving the financial sector a put option. The put option is they can take a liability that they have and they can stick it to the government, and they do so when it's profitable for them to do so. So in designing these programs, of course, we're all aware of that. You have to, there's a trade-off here. You're trying to help what we might think of as the sympathetic borrowers, but you're not trying to help the guys who are the speculators and so forth, took advantage of the system. And at the same time, you don't want to bail out the financial institutions that were engaged in the kind of moral hazard that we're trying to prevent. So it's a very tough balance. This is actually a microeconomics problem, not a macroeconomics problem. In designing, in mechanism design, kind of thinking about the kinds of structures that you want that will get just the right people involved, and it's a difficult problem, but certainly an intellectually challenging one, and one that's been somewhat effective, but not without its difficulties, to say the least. All right. Well, the third thing we did was was what's called the TARP, Troubled Asset Repurchase Program. And that's the $700 billion program that was launched about 6 weeks ago. Most of that money, all of that money so far, has gone to the recapitalization of the financial institutions. And we will probably end up during this administration only using up to the $350 billion and leaving the other $350 billion for the Obama administration to deal with. We believe that the approach that we've taken in terms of capitalizing the financial sector is the right way to go. That's based on two things. One is logic, and the other is empirical evidence. The logic is this. If you look at the problems right now that are out there, housing wealth declines have been substantial, about $1.5 trillion since the peak. But probably more important than housing wealth declines are stock market wealth declines right now. The stock market wealth has declined by, depending on when I look at it, and I looked yesterday, wasn't so cheery, it's somewhere between $6 and $7 trillion in terms of losses. So you're talking about losses of wealth from the stock market that are 4 times as great as losses in the housing market. So until the stock market turns around, we're going to have some pretty negative factors pushing toward lower consumer spending, and that's going to be very problematic for the economy, not only for the U.S. economy, but for every economy that's connected to the U.S. economy. And the same thing is true, by the way, in other economies. I just did a briefing on the APEC, for the APEC summit. The president's going to the APEC summit starting Friday. And if you look at the APEC countries, they've all had declines of similar magnitudes in terms of their stock markets as well. Chile is the one exception. It declined only 15%. The rest are all above 30%, and some are as high as 60%. So with those kinds of wealth declines that you're seeing in the stock markets, you know that there are going to be problems in terms of consumption. So why is the focusing on capitalizing the banking sector the right thing to do? I'd say 2 reasons. One is you need to get investment going again. That's clearly a key factor. So in order to get investment going, you got to get lending, you got to capitalize the banking sector, you have to make sure that the financial sector has the resources to lend. When lending starts taking place, one would expect that firms' outlooks will improve, profits will continue to grow. That should be reflected in stock prices if you believe in the fundamentals driving stock prices, at least over the long haul. And so what we expect is that stock prices should rise, and that then, in turn, will restore some of the wealth and undo some of the negative impetus on consumption that we're seeing right now. So I actually think of capitalization of the banking sector as being the primary way to go in this. By the way, as I said, that's logical, but it's also based on historical evidence. If we look at countries that have had similar or financial crises in the past, and I think of Sweden, Mexico, or even Japan, none of those countries turned around until they did significant recapitalization of the financial sector. Sweden started early. They did that basically right away and turned it around pretty quickly. Mexico coupled that with some other things, but I think that was the primary factor. And if you look at Japan, Japan kind of diddled around for a while from 1992 until about 1998, buying up troubled assets, doing a variety of other things, trying to prop up existing firms, and eventually they just gave up, and they pumped $450 billion of capital into their financial sector starting in 1998. If you look at their economy, they're about 1/3 the size of the United States, so you can just see the order of magnitudes, the order of that you need here in order to get these things going. But it did seem to work in Japan. Basically, within a couple of years, they had turned things around. All right, so, oops, where am I going here? Wrong way. All right. Well, so what is that? Where does that leave us? Well, there is some good news. I always like to end with a little bit of good news. This is a pretty bleak story. One piece of good news is in the housing sector. If we look at the housing sector, it appears to have flattened out over the past 6 months or so. We've seen that before, so I never get too excited when I see this sort of thing. But if you look at housing sales, you'll see that there is a flat period at the very end there, and actually turned up a little bit at the end. So we're starting to see housing sales pick up. The inventory to sales ratio has actually fallen by about a month recently. That's significant. So, you know, some positives there on the housing front. The other thing we're seeing is that in financial markets, the sorry, now I blew it. Hang on a sec. In financial markets, we're seeing these LIBOR rates coming down, so there is a good bit more interbank lending now. That was helped in large part, I think, by guaranteeing the bank liabilities. That was done through the FDIC, very important step in terms of building confidence in that market. TED spreads are down. Rates on commercial paper for highly rated financial and non-financial companies have come down some. Again, that market, as I mentioned, is still frozen relative to where we'd like it to be, but it's moved in the right direction. And then finally, inflation has moderated. Yesterday's CPI numbers were actually negative, big negative, minus 1%. Most of that was energy, but even the core was down minus 0.1%. So, 1 month doesn't tell you a whole lot. We've had some core rates that were pretty high in recent months, but it looks like inflation is moderating, and that's a good thing. It means, of course, that the Fed doesn't have to worry about that. It's one thing that they don't have to worry about, at least for the short run. They got a lot of other things to worry about right now. So why don't I stop there, end on that. Oh, one other thing, of course, is that oil prices have fallen. That's a big deal for the U.S. economy. Our numbers, my group's numbers, internal numbers, we usually estimate that for every $10 a barrel of oil, that translates into about 1/4 point of economic growth. So, with a $60, $70 drop in the price of oil, that we're talking about another 1.5% of GDP growth there. So that's quite significant, and that will be a big help. Unfortunately, it's probably dropping for the wrong reason, but we'll take what we can get right now. So anyway, why don't I stop there, and we'll open it up for discussion. Mike, I guess you're going to make some comments. Yeah. Thank you.
Thank you very much, Edward. I think your presentation clearly shows the formidable effort that has been undertaken to move things around and to change the scenario in the U.S. and the global economy. Michael?
I'm an interloper here, and I actually spent several minutes at the end of the talk I gave on sort of growth in the developing world on this, and so I'll avoid repeating some of that and just make a couple of comments so we can have some discussion in here. The thing that I believe the authorities in both the United States and Europe deserve a great deal of credit for what I call emergency response. And that means injecting liquidity speedily and taking other very unusual measures to prevent the credit lockup, which is, if allowed to happen anywhere, including the developing world, is extremely damaging. I mean, that's the depression kind of scenario where you destroy things willfully. I think Eddie's right. It's going to take us a long time to figure out how this happened. I mean, I believe that part of that story, in addition to incentives and failures in various parts in terms of regulation and ratings and so on, is going to be the fact that the risk models didn't work, and risk, which people sort of thought, I'll exaggerate a bit, was exogenous, stationary, and uncorrelated, turned out to be endogenous, non-stationary, and increasingly correlated over time. And it wasn't noticed. And the best evidence of that is the major financial institutions in the United States and Europe held these assets which were exposed to these risks, and their balance sheets failed at the same time, giving us the need for the crisis activity. The thing I'm most worried about, I think this is a global problem as well as a domestic one, is the very real possibility that we can't stop an asset deflation overshoot. And the reason we're likely to get it is that the asset prices have been completely or almost completely disconnected from anything like intrinsic or longer run value, or what Chairman Bernanke called in the context of the housing discussion hold to maturity value. And the reason for that, and this does relate somewhat to the mark-to-market issue in Basel II, is that when those prices get disconnected in that way, then a vicious cycle starts in which there's fear, redemptions, capital calls, collateral calls. AIG failed on collateral failures. Anybody can have an opinion on whether or not, if they'd held out somehow, they could have delivered on the credit default swap insurance contracts, but they just didn't have enough collateral that was required as part of those contracts. So you get damaged balance sheets, the need for more capital immediately, dumping of assets, not because it's a good time to sell, it's just because you have to, if you're a mutual fund or a hedge fund, and withdrawal of capital from the rest of the world. So the damaged balance sheets we're part of what we're seeing may be a flight to safety, but I think it's more a flight to restore the balance sheets, creating a vacuum that initiated in the developed countries and now has been extended. So you see it in the exchange rates, you see it in the credit tightening in many markets. And it would be nice if we could find ways to prevent the worst form of an asset deflation overshoot. Recapitalizing financial institutions obviously helps. Emergency sort of reversals of these capital flows led by the dollar swap facilities, the IMF resources, and maybe, hopefully in the future, the reserve currency countries will help with that. But if we can't stop it, it'll make the starting point for dealing with an ugly recession through the deleveraging process. It will put more burden on the fiscal stimulus side than is perhaps necessary. So I think that's a very kind of short summary of where I think we've gotten to so far.
Thank you very much, Michael. Well, we have two options now. We either start a debate or else if you have questions for each other. Okay. Why don't we open up for the debate?
My question is for Mr. Lazear. You were talking about the change in the TARP program direction. Of course, that capital injections are like a sine qua non condition for the bank recovery. But I was wondering if letting the banks keep on their balance sheet the toxic assets, the mortgage-backed securities, can it lead to a situation close to the Japanese experience with their bankings? I mean, we still have like probably a year of a very hard condition on the housing sector with prices falling. And so I find it hard to see the markets believing in recovery of banks when you still have all those weird assets that are whose prices keep falling. So we'll probably stick for a while with a scenario where banks have to continuously make write-downs, and I don't know. I can see how only the capital injections will let the asset prices, the banks' equity and shares recover.
Okay. Good. All right. Well, let me answer that in two ways. One, again, is logic, and the other is empirical. The theory basically tells you that it's a dominant strategy to give these guys capital rather than to buy up a particular troubled asset, because they can always take that capital and essentially buy it from themselves. So, it's better to have the flexibility on their part than to not have the flexibility. And I think that's the way I would think about that. But that's not the main motivation, I think, behind using capital injection. Again, as I said, there were empirical motivations for doing that. But also, if you look at the mortgage-backed securities market, or if you look at, those are residential, if you look at the combination of residential mortgage-backed securities, commercial mortgage-backed securities, asset-backed securities that take the form of car loans, credit cards, student loans, and so forth, and you take all the securitization and ask, how much is that in terms of dollar value? You're talking about $2.9 trillion of assets that have default rates right now of somewhere above 20%. So ask yourself the question, is it possible to buy up all of those, or a significant enough fraction of those securities, and take those off the market? And the problem is, it's probably not. You just can't do that in any reasonable way. Now, what you could do if you wanted to, and there might be some value to doing this, would be to pick selective institutions and to say, well, we might couple buying some of your assets, buying your troubled assets, give you a put option, essentially, to combine a put option on troubled assets with your willingness to take capital from us. That might be one way to go, and that's a possibility. People have discussed that as something that the Obama administration, may wish to consider. But again, I would think that the main focus should be on capitalization, simply because there's no way for the government, unless it's going to do it at just an enormous, massive scale that I think is just beyond what most people would think of realistic, to clean out those assets. Now, again, I mentioned the empirical evidence. Japan tried to do this from 92 to 98, and it's just very difficult to do. You just find that it's almost impossible to get enough of the assets out of the system. You basically have to segregate them like Sweden did, where they created a bad bank and a good bank sector, and then everybody knew that the bad banks were bad banks, and they were priced appropriately, and then they just capitalized the heck out of the good bank sector, and that seemed to have worked. So I would expect that to happen over time. You'll tend to see that, not from the government doing it, but I think you'll tend to see that happening as banks just do that naturally and move their bad assets into one category and their good assets into another. And so we'll expect that to happen, but hopefully it'll happen quickly rather than slowly.
Thank you.
Professor Luizio. Professor Luizio.
There are some suggestions among economists that perhaps you need to have like a bankruptcy law for banks, or to make invalid some of those contracts, or just so that certainly would be high interference in the private sector, but at the same time would be a quicker way to clean up all those assets. Now, do you think there's a room for that, or?
Yeah. You guys want to comment, or you want to go first? Or I'll go if you want. Go. You want me to go first? All right. I was sort of hoping to toss the ball to you, actually, but all right. Well, I think the bankruptcy issues are key here, because the big problem that has plagued us is how do you get these guys to fail in a way that doesn't create systemic risk for other institutions. And people have suggested a number of mechanisms of orderly bankruptcy, or a prearranged bankruptcy, prepackaged bankruptcy kind of arrangement where we know what's going to happen, have been ways that people have thought about it. The question is, can we do it quickly enough, and can you do it midstream? So we're right in the process of this right now. You see troubled institutions. Something comes up like Lehman, we sort of knew Lehman was in trouble, but when it gets to the point that it's actually at a crisis stage, you basically have a weekend in which to do this. And so the question then is, are we able to set up laws or structures right now that will deal with all the things we have coming at us in the next few months? I'm not sure that we can pull that off, but there would be a lot of, I think some of the things that we were chatting about last night that you had suggested, I think might be ways to go in this in terms of orderly asset positions. The one thing that I'd point out is that the big problem has been the counterparty risk. And Mike, I just want to comment on, this is a little bit off from what you're asking me about, Aloisio, but let me comment on something that Mike said that I think is particularly important. One of the things that Mike mentioned was he's talking about how these risks were endogenous and correlated. And, there are laws, there are regulations to take care of this stuff right now. In some sense, it wasn't so much a failure of regulation, although you could call it that. It was a failure in the way in which the regulation was applied, because all of these financial institutions are required to do stress tests to see how close they are to insolvency, to bankruptcy situations. And they did these stress tests. The problem is they just did them wrong. They did them wrong because they didn't understand the underlying model. And so it wasn't, if you kind of said, well, let's go back and fix this thing, you'd say, well, you got to do stress tests. You guys didn't, you didn't check for the robustness. Well, they do them. They just didn't know what the world was going to look like. And I think that's the problem. So when I'm sort of thinking about the bankruptcy question that you ask, what you would want to do, and again, I know you've thought about this a lot more than I have, and I'd certainly welcome your thoughts on it, is you have to think about structuring institutions that are robust to the kinds of shocks, correlated shocks, counterparty risk shocks that we really didn't anticipate. And whether the bankruptcy would do that or not, it's not clear to me how one would structure that. I'd have to think hard about that, and to be honest, I don't have a solution on that right now. So, you know, but maybe you can educate me at lunch in this afternoon.
Yeah, I agree with that. There's a number of things that we could do to make this, you know, in anticipation better. But I do think the central question, whether it occurs by investor learning, you know, is to solve the problem that Eddie just described, which is, you know, you cannot build a regulatory system that can protect itself against a kind of fundamental misconception about what the nature of the evolving risks are. And you know, it's fairly easy with the benefit of hindsight to see what happened. First, by and large, the risk models were, you know, assumed the risks were exogenous, uncorrelated, and largely, you know, non-stationary. And the system as it evolved didn't throw up any data to disprove that assumption until it broke at the end. So there were contrarians in the system, and there's two things that happened to them. One, they were ignored, and two, those of them that were managing other people's assets, you know, the word on the street is you can be a contrarian for 2 quarters and then people go somewhere else. So the investors voted with their feet along with it. There's other solutions like this. People say, well, you know, we're going to make these originators and securitizers hold the assets. Well, if you just think about it, that'll work great if there's asymmetric information, you know, and the people who originate them know more about the risks than the other people. But, you know, there's a lot of entities in the system, including all the major financial institutions that not only were involved in the securitization process, but held large enough quantities of the assets so that when the whole thing went bad, the balance sheets went, you know, and they're supposed to be the most sophisticated players in the game. So I really think, just to support what Eddie said, there's a lot of fast answers coming out, you know, that are based on what I would call sensible pieces of the puzzle. But we're really going to have to sit down and develop a kind, you know, the whole practitioner and academic community and really understand in greater depth than we do now, you know, what the dynamics of the system were that got us to the point where, and there may be a few things we can do. You know, I think we will, one of the things that happened at the end when it broke is that all the channels performing the normal functions, I mean really normal, like short-term credit provision and payments, started to break. And we fixed them on an emergency basis well enough not to wreck the economy through alert action. But we may need a highly regulated subsector of the financial system that is simply not allowed to take enough risk to fail to be a channel. I think of it as a public utility, so that even if the rest of the system breaks, at least there'll be a channel through which you could produce commercial paper. You see, people think there isn't any money to buy commercial paper. That's sort of not true. There's a ton of money out there. There's no channel that's safe to get it from the lender to the borrower. So part of, I think, the design of this going forward is going to be to think carefully about channels and maybe keeping some of them quite safe.
Okay, thank you. The floor is open. Oh, okay, thanks.
We had a remark about the inflation rate for the last month and the Fed not being too worried about it. But I can tell you as a Latin Americanist that a lot of my friends who are unfamiliar with these big bailouts are now asking me, because I've seen these happen where we are, how this is not going to be in the long-term inflationary, because we're eventually going to have to pay for them.
Yeah. You know, I think we certainly are worried about inflation in the sense that you always worry about inflation. And if you look at, the recent history and the recent comments by the ECB, for example, they have been worried about inflation until just a couple of months ago when they switched their policies. And I think that wasn't an irrational view on their part, that this is something that you always have to keep in focus. The question, I think that we have to deal with right now is that the most important concern, or is it a secondary concern? And I think the Fed has made the judgment that it's a secondary concern. Not that it's not a concern, but that it's a secondary concern right now, simply because at this point, people are talking about deflation, actually, not inflation. And I think that's when you see, again, the stock market declining in the way it did, other assets, housing assets, and so forth, the issue will be whether that's the more immediate danger. Now, I certainly take your point, and I think it's easy to kind of err in the direction of overshooting in terms of not worrying about long-term appropriate monetary policy, and I'm very hopeful that the next administration and the Fed over the next year or two will bear that in mind. One could argue that they didn't bear that in mind appropriately maybe 3 or 4 years ago. That's certainly been an argument that's made. If you look at it compared to, say, the Taylor rule, we know that they deviated pretty significantly from the Taylor rule, and a number of people are critical of that. I don't know whether I would be critical of it, but I'd remind you that when they were doing that, they were also worried about a double-dip inflation. So this was back in 2003 when things looked like they were starting to turn south again, and they had to make that trade-off. Did it turn up show up in higher inflation rates later on? Well, probably not so much, but it's conceivable that we could see that in the future. And beyond that, I don't know really what else I can say. I mean, these trade-offs are always there, and it's something that we always worry about.
Which you may have been referring to, sorry. And that is, we'll have a rather different looking balance sheet and a rather different looking fiscal situation, and if we do not then, tighten the belt and absorb the pain associated with restoring that, then we could have long-term inflation as well. So that's in the future.
Okay, the floor, please.
One of the solutions to this problem has been for the government to provide capital to the private sector. My question is, has the government exacted the correct price from the private sector?
Whose question is that?
You can't answer.
You go ahead.
I have been a defender of the government, in this respect, because I don't think you get to dance on the head of a pin in an emergency where the downside risks are that great. And I think they've been alert and made, tough choices. I mean, not often does a central bank get up in the morning and get to choose between bad, worse, and truly dreadful. And that's what they've been choosing among as options recently. But they've also been alert to the fact that and as has the investment community, that we are creating risks in terms of expectations associated with moral hazard and other things that we're going to have to wrestle with later. I don't think there's been any head in the sand stuff here that I can detect. So I'd be a defender of the trade-offs that have been made.
Let me pick up on that. I actually want to refer to one of the theme of Rafael's point about procyclicality. I guess the thing that I would say about this is that markets are ruthless in terms of punishing capital. So if you look at what's happened out there, if anything, I would say that there's been an overshooting. This is a situation where people say, well, the markets got drunk, and now they won't even take a drink of water. Everything is so frozen up at this point, and you ask, are we extracting the right price? I don't know if the government is extracting the right price, and I think I will punt on that for the reasons that Mike said. But I'll tell you, the market is sure extracting a huge price from these firms that have engaged in reckless policies, ex post reckless policies. I'm not as concerned about the moral hazard aspect of it. If I think about, were I out there right now and I'm saying, gee, the government's going to come in and bail me out, given the way that the government executes policy, not just this administration, but you have to guess on what future administrations will do, which firms will they end up protecting, which assets will they protect within the firms, and that's a pretty tough call. So, there's always a moral hazard issue. I certainly worry about the moral hazard issue and extracting the right price and protecting taxpayers. You always want to do that, I think. But again, I rely primarily on the market to do that, and not the wisdom of the government to do it. I think the market's done a pretty good job of punishing these guys.
Okay, we have just a few minutes left. Yeah, one last question, please. Microphone.
I have a question to Rafael. Your model assumes homogeneity of borrowers in the quality of borrowers in each state of the economy, right? So I would appreciate your thoughts on the impact of if you assume heterogeneity of borrowers in the quality of borrowers on your results, because this would perhaps allow the credit rationing to occur in a more multidimensional way. The banks could could change the credit quality of the portfolios, right? Thank you.
Right. Yes, indeed, the model assumes that all borrowers are identical, except for the sort of time dimension, that they may become safer as the economy goes into a good time, or may become riskier, but all of them at the same time with the same risk characteristics. Now, the point of the paper was to focus on this time series dimension of the capital regulation, as opposed to look at the benefits that come from this cross-sectional differentiation across of different borrowers. So I think that we were concerned mostly about the second side. Now, I agree with you that there's an interesting dimension in terms of the cross-section and how this might interact with business cycle developments and what's going to be the impact of the rationing on the types of borrowers that are going to be suffering. And this is something that I think is an interesting topic for future work, but we haven't done anything on that. Thank you.
Okay, thank you very much. Now I would like to make a final round here with our participants, and I would like to focus on the priorities going forward. Beyond this crisis resolution mode that many of us are now having to deal with, what will be going forward from this experience with the benefit of hindsight, what will be the one or two key areas in terms of financial regulation going forward?
You want me to start?
Yes, please.
Okay. Well, I would say three things, and I wouldn't focus on financial regulation per se. I actually looked at this recently at an empirical level, kind of looking at countries around the world that have done well and done well recently. And I would say there are three factors as you look forward. You know, it's easy to kind of get caught up in the current situation and to say we need to control this and regulate this and protect this, and I think that would be a huge mistake. If you look at the pattern across the world and you ask which countries have done the best, you know, there are certainly exceptions, but for the most part, they have been the countries that have been the most open to trade and to international interaction. They've been the countries that have kept taxes relatively low, and they've been the countries that have remained flexible. And right now, I see, at least for us, a danger in going in the opposite direction, becoming more protectionist, which I think would be a huge mistake. Raising taxes, particularly as punishment, I think would be a huge mistake as well. And tightening up, trying to protect certain industries, limit the ability of the market to adjust, I think that would be a mistake as well. So I hope that as we go forward, the next administration will bear the historical lessons in mind and make sure that they adopt policies that are consistent not just with the current situation, but with helping to ensure that the U.S. economy and the world economy grow for the next couple of decades.
Thank you very much. Michael?
I certainly agree with that. I guess I would add that I think it's become clear that there's a kind of interdependence that we now have that requires that we address these things globally. There's the potential for contagion, there's the potential for regulatory arbitrage, there's a lot of things, and while we may not have exactly the same approach to regulation, we certainly have to spend time together making sure that it's not dysfunctionally put together. So that would be my first item. And the second one is I really think in order to find the right balance between safety on the one hand and excessive cost in terms of reducing legitimate risk spreading mechanisms, and therefore, in the end, raising the cost of capital, we really should take our time and get the best minds together and do a thorough analysis before we sort of go hell-bent for leather on a variety of regulatory fronts.
I very much agree with this statement. I think that the big danger is rushing through half-baked ideas on regulation and ending up with an over-regulated and inefficient system of regulation. I think that Ed pointed out, we are dealing with delicate mechanism design issues that are going to affect the incentives of the players, both private and public, and I think that things of rushing immediate actions by March 31st, 2009 is probably not a very good idea, even though politically is probably what you would have expected to happen. Now, on the Basel II front, I think that, let me come straight. I think that the Basel II framework is the right framework. I think that it should not be thrown away. I think that you should change the numbers, but I think that the basic structure is the right one, and I don't think that you should sort of start from scratch thinking about a new framework, either Basel III or going back to simple leverage ratio. I think that would be wrong.
Right. Thank you very much. And with this, I think we conclude our debate. And I would like to thank personally my colleagues here, Edward, Michael, and Rafael, for this great